but naturally we got to work in this economy, right? But we're going to continue on with our investment discussion with Robbie G and me, just sort of shooting the shit and flapping our gums about the markets and how he sees them as a person that's been in the field for quite some time, and not to get too detailed about it, but what we'd like to talk to you today about is the history of the markets, where they've come from and where they're going, and maybe just drive home the point of the actual auction process and the auction mechanism of the market. So without further ado, we'll get it going and start out with the futures and the old pits, like in Chicago and stuff. How things used to be traded back in the 1900s, when you actually had physical guys down in the pits. That's definitely.
It's still up until very recently, certainly not.
Okay.
They're not what they used to be. That's for sure. But.
Well, I mean, everybody has the visions in their minds of like the movies, like Quicksilver, or to get into equities a little bit, Wall Street, where you actually envision these sweaty guys in colorful jackets pushing each other around and shouting and making weird hand gestures.
Right. It's called the open outcry process. The purest form of an auction, and of course.
Well, that open outcry term actually dates itself back historically to when it was actually an open outcry, and somebody was bringing a product to an area and just shouting that they had a certain product, right?
Right, and who wants to pay what for it, and here's what I want, and again, really the same process that that transpires in the pits, but electronically, it's the same thing. You're just it's a question of algorithms or matching engines or whatever, basically looking at the same thing that's in the pit. In the pit, you have a physical representation. Okay, this guy wants to buy 500. This guy wants to buy 50. This guy wants to buy 100, and then so and so wants to sell 100, sell 50, sell 500, and then you're seeing in each case whether again, I'm just talking about an auction in general. It's only a question of concession, right?
Right.
In order for a price to tick up or tick down, either a buyer who would like to pay a lower price, obviously as a buyer, has to concede and pay the seller's price, or the seller has to concede and agree to sell at the buyer's lower bid rather than what he would like to sell it for. Obviously, the difference between those two prices is what we call the offer and the bid, or the ask and the bid. And then when we talk about those two things together, you're talking about the bid-ask spread, or the spread, which could be any range of prices, right, between the two things. And in the pits, typically the pits are comprised of what we call locals, which are typically independent guys who are not affiliated, not necessarily, but typically and traditionally. When people talk about locals, the typical picture that they would paint of a typical local is an independent guy who either bought or leased a seat at the exchange for the express purpose for being a speculator in whatever the commodity that he wanted to trade.
Now, briefly though, the other people that would be in the pit would perhaps be, say, people really looking to hedge or something along those lines.
Yeah, both. I mean, typically, a hedger is typically an end user, so they wouldn't be in the pit. But the other people in the pit that you're referring to would be the brokers. and which we in the industry we call it paper. Paper meaning that, as in the paper that comes in to the desks outside the pit, which are the orders, and that paper is given to the floor brokers that are standing in the pit. And what's on that paper is a representation of whatever that investment house or bank or whatever would like to buy or sell of that commodity. So, runner.
So our locals, locals then would fill the gap that may exist between the buy side and the sell side of the paper.
Yeah, basically make the market, as we call it, where what it really is it's the purest representation of a non-zero sum game, right? Because the goal, of course, for the paper is to work the orders for their customers, or work the orders for whatever the bank's objective is, which is typically longer term, right? Mm-hmm. So they want to buy or sell something for the longer term. Maybe they're going to hold a position. And what the local wants to do is to actually provide liquidity to actually to fill those orders for the paper in the short run, and then actually profit from the short-term price differences that are created from the auction itself. That's probably the easiest way that I can describe it. So in other words, for a given transaction, the local can actually make money, and then eventually later on the same transaction, the paper can make money too. So the local might buy what paper is selling, but in the process of paper selling, because they're working a large order, they're not able to get it all on. So it starts to move the market down. And then the local buys into that, knowing that eventually they're not going to have any more paper to push into the market. And then guess what happens, right? The market stalls. It doesn't go down anymore. So the local's trying to buy when it stalls, and then obviously as a result of that stalling, it's going to bounce back up again.
Right.
And they're going to scalp a tick or two off of those inevitable motions that happen, in any auction.
So if I understand,
it's much more dynamic than this, of course.
Well, I mean, we can keep it kind of like this. So if I understand you correctly, the person on the buy side of this paper transaction, let's say the locals didn't exist, and you had an idea.
Both sides now. I don't want to interrupt you, but
okay.
It's not necessarily buy side or sell side. I mean, paper can be buying or selling.
Well, I know. Well, what I'm trying to do is I'm trying to make it omnidirectional for the reasons of explaining it.
Okay, so right now, paper's selling and the local's buying is what you're saying.
Well, right.
Scenario, right.
But without these transitional locals, there would be a gap, and then all of a sudden that market would bounce hard, right? Like, so the local functioning is kind of a price cushion, a liquidity cushion?
Right. Well, they're providing liquidity because in the pits in Chicago, there's, and I know you want to talk about this later, but there isn't the same process or controls that are in place for actually making the market. So the goal, obviously, in making a market is what happens, for example, if there weren't any locals in the pit, right?
Right.
And all the paper and all the banks wanted to sell, and none of the banks and other brokers from the banks wanted to buy. You have a market that can't go anywhere. So even though you have sellers that want to sell, they actually can't get a trade that's facilitated. And of course, the goal in any market is to facilitate trade no matter what. If somebody wants to sell, maybe they can't sell at the best price, but they should be able to sell at some price. And in order to be able to sell at some price, you have to have somebody willing to take the other side of the trade. And that's typically the role of what the local provides in the pit, because in the Chicago pits, there is no designated market maker that is an employee of the exchange like you have in the NYSE, for example, in New York, trading equities. There's no designated person that has a compulsory requirement to take the other side of the trade to maintain an orderly market. So the difference is in the pits in Chicago, these local speculators, short-term speculators, are naturally providing the liquidity, and it's just left to work itself out. Whereas on the NYSE floor, the traditional method was a specialist who represented a particular stock. Of course, you have multiple specialists, and in the event that brokers brokers were coming to that specialist with a whole bunch of sell orders and no buy orders, the specialist is required to take the other side of the trade because he's not allowed to be a speculator. He has to sort of maintain inventory of buys and sells, create the spread between those buys and sells, and of course, what he's making is the natural difference between this matching the sell orders and the buy orders. And in those weird instances where he has to take the other side of the trade, he has to maintain the inventory, float it, and then eventually he'll unload it.
More or less shoring up the walls of the auction house.
Right,
You know?
right, very much so. So very different processes in the futures pits in Chicago versus the traditional NYSE exchange process, which, of course, the pits, Chicago, ironically enough, hasn't really changed a lot in this technological revolution that we've had. Chicago has gone from the futures business I'm talking about in particular. There's a lot of futures exchanges around the world that are traditionally operated as in that fashion with the pits and the locals versus the paper. But all that's really happened as the pits have gone away in Chicago, things have moved to what the CME calls Globex, which is basically an electronic market, for each one of the markets that traded in the pits. And some of them still trade in the pits too, of course. But all Globex is really is a matching engine, where there isn't a market maker per se. It's just a matching engine, but it's the only one. Okay, so all the CME has done with Globex is basically take that natural process that used to occur in the pits and now move it to the screen where they just have a matching engine. So the paper's still there and the locals are still there trading these futures contracts. They're just using a mouse instead of being there in person. And they're still equally divided, and there's still, short-term speculators like me personally. I mean, not for my business, but I'm a short-term scalper, and so each person can fulfill whatever role that they want to, and institutions are very much involved in the futures markets too, and they're still doing or representing the same role that they were in those markets for longer time horizon trading and things like that. So it just works itself out naturally, but there isn't any competition. If you want to trade S&P 500 futures, 10-year note futures, whatever else is trading, for example, in the CME complex, for example, there's no choice. There aren't a bunch of exchanges that are listing that same stock like you have in the equity markets that are competing for that space doing different things. It's still one market that's centrally located. So that's why I say the transition from the pits to Globex is really pretty natural.
Well, we've exponentially, if not ballistically increased the number of participants. I mean, it's crazy.
Right, just because of the sheer ease of it all.
Right. Well, I mean, versus when you have, versus back in the day when if you wanted to trade, you needed to lease a seat, right?
Well, you didn't. I mean, you could obviously
work through them.
You could work with a broker and call a broker, but that order, you had to get, in most cases, pretty delayed price quotes that had to come from the floor.
Right.
You had to work with a broker who would call down, to the floor brokers and get information for you, and what's the spread right now in treasuries, and then that information would be relayed via the telephone right off the pit with the noise and the whole thing. So it was very different. If you wanted to trade, if the average person wanted to trade futures, even in the in the 1980s or the 70s, that's the way you did it. And of course, now anybody can get software basically for free, pay a small amount for real-time exchange fee data. In many cases, you can have that waived too via your broker, pay a very low commission and exchange fee, and trade, in these markets, and they are more liquid than they've ever been. Treasury notes are trading, between 800,000, 1.5 million contracts a day. The S&P is trading between 1 million and 2 million a day. Tremendously liquid, efficient markets.
Well, now going back to where we are today, we went right past it in a quick facet in a hurry. But back when we used to have to phone it in and go through a certain number of people, where there were only a certain number of bidders, the distance between the buy and ask, the spread, would be much greater than when you have many different participants with many different time preferences and goals and things like that.
That's absolutely right.
Right.
Absolutely right. Yeah. And when the spread was wider, and it's good that you brought that up to punctuate what the local was trying to do. Back in those days, it was if a market was, even if a market was what we call bid offer, meaning that they're as close as they could possibly be based on what the typical spread is. It's whatever. The market's it's 6 bid, 7 offer is what you might see today. But back in those days, there might be 6 bid, 10 offer.
Mm-hmm.
So there's 4 ticks in between the bid and the offer. So if they can buy on the bid when the market's slowing after papers move the market down a little bit, and then that market slows and stalls, and then it ticks up, and instead of being 6 bid, it goes to 10 bid. And then even if it's 10-11, they unloaded 11, they just made 5 cents. Right, 5 ticks rather in that case on the contracts that they're trading. So, ironically, for the pit local, right, the pit local did a lot better when the spreads were wider, because that was his goal in making the market, was to capture that spread, just like a specialist does on the floor, right?
And I imagine
if the spread's wider, the specialist or the local makes more money. If the spread's narrower, it means that that typically the retail trader that's working the order through the broker gets the benefit.
Yeah, I can imagine how it'd be tougher.
That's right. He's paying less to trade now, or it's costing him less to trade over the life of his trade, because that difference in bid-ask spread isn't coming out of his pocket.
Well, and it had to be a different type of trading too, considering the volume, because we used to have this bottleneck 20 years ago. Just the difference in price action. We can look at the charts and see. Well, let me rephrase that. Short-term price action. I don't want to get too off the rails here, but it's something that has put a lot of pit traders out of business, right?
Yeah, and most of what has made the pits go away really is just Globex volume, not so much the spreads.
Okay.
There are several pits that are still very active, and creatures of habit, I guess, to a certain extent. It's not. You don't hear about anybody anymore as a local that's really choosing to buy a seat and go down and try to scalp treasuries for a living. Those days are kind of over. The dinosaurs, I think, are still there, and they still have their positions in the pit, and they're respected, and to a certain degree, they can probably always make a living through their brokerage relationships. It's a kind of a one hand washes the other to a certain degree, because form follows function, right? The orders have to get worked, and there has to be somebody on the other side, and it's a dance, and it can work out for everybody. But
well, and I see their role, and this is something that you and I have talked about off camera, off recording, in that I think there will always be a role when the rubber really meets the road, and we're really dealing with real money and real people. The actual interactive skill that the person-to-person pit trader had, I think. There should always be a place for them. I hope there is.
Well, that what you're talking about, those human relationships, was an edge that justified the price of a seat. When you could only trade via the phone, or even in the first iterations of screen trading, it was definitely a disadvantage because of a lack of information more than anything else. So just physically being there in other words, there is no electronic market. The electronic market is just a visual representation of what is the pit market, right? Which is the way it used to be. So you might be on the screen, but you're not seeing what the guy in the pit is seeing. You're not seeing the look on the Goldman broker's face when his runner came over to him and whispered in his ear.
Okay.
You're not seeing that what that means, and over your experience and working with him and all it is. Holy crap, this guy's about to really unload, and I'm gonna, jump in and get on this freight train before it happens because I saw this little thing. Or in an adjacent pit, seeing that the biggest local in the end pit is stepping up and screaming, and the end's about to break, and you're essentially arbitraging the end versus bonds or whatever you're doing. So all of these things used to be of huge importance but only because the pits were the center of that trading universe. They're not anymore. So even the pits that are still in existence, their volume subservient to their Globex counterparts for the most part, with a few exceptions. The meats, like live cattle and lean hogs, are still very much local pit markets. Orange juice, there's still some markets that heavily trade in the pit.
But now, so
predominantly commodities that have a very strong hedging component.
But what we are still left with is the price. Whether or not I was, say, a participant in the 80s and I wasn't there to see the look on the banker's face when it happened, I was able to see the price a couple of minutes after its occurrence. That's something that hasn't changed, the price. When people talk about things being priced in, I'm wondering how many people really understand what that means. When something was priced in the pits, that's kind of what I get from it, that the guy's like running, screaming at his runner, screaming at his floor trader, screaming at the specialist, whatever, if we're talking equities.
Well, in the analogy that I just gave you, it's sort of the easiest way to imagine it is that, the market always knows, right, before it happens. And it's that way electronically too. Markets have an uncanny way about them in this sense, but it's sort of like the analogy being that the guy looks like he's going to sell, so therefore everybody sells. So therefore, before he even sells, the market has already gone down, which is what you thought would happen in the first place. So now it's too late, right? So now if you try to chase it, the sell the rumor, buy the news, kind of mentality. But that's very much the case all the time. I mean, the price is truth, as you're saying.
It was such a perspective change for my own trading in price. Whenever I would, when I understood that I was in fact a speculator, and where I thought price was going back when I was leaning a little bit more towards fundamentals as opposed to where I'm at right now, instead of trusting where the price is at the moment, where the Dow closed or where, just as an example, where anything's trading at the moment, I would somehow in the back of my mind believe that the market was wrong and that it would quote unquote correct, which, I mean, you guys use that term anyway, but for a different, for a different reason.
But that may be true too. I mean, I think it doesn't exist in a vacuum. I mean, it's
well, no, it doesn't. But perhaps a mistake that some make is in fact that they cannot exist in the present tense when they're trading, and that's, I think, so important to be in the present tense, even if you are speculating where it's going. If you don't have faith in where it's at, how can you really properly determine where it's going? Or really have faith in your move that you're going to need to have faith in, if that makes sense.
Right.
And that's something that hasn't changed. And historically, maybe there was an advantage if we can talk about equities for a moment. When on Wall Street, when a person would bring a bushel and just flop it down on the thing, and a guy up in the third story window would run his offer, the outcry it was.
Right.
There would be perhaps historically more faith because you just saw that bushel of wheat go for whatever, $1 or whatever, Yeah.
The purest form of open outcry where there was. I mean, you were taking delivery when you traded of an actual physical commodity, and you could still do that, of course. I mean,
oh yeah,
you could take delivery of anything for the most part. in the commodity space by trading the futures contract. So, but the process that you're talking about of price being truth and it working itself out naturally hasn't changed. And of course, that's one of the most hotly contested topics of late, is the notion that because a computer, for whatever it is making a decision, then somehow that relationship, that price relationship, is no longer real because it's a computer that made the decision. And when in fact it was a human that made the decision, because he's the one that told the computer what to do when such and such happened.
It's ironic in such a in such an information age where we're talking about this on a computer. People are watching this on a computer, yet people don't comprehend the human behind the computer anymore for some reason. Like, that doesn't apply.
Yeah, it's interesting, isn't it?
Well, that brings us to high frequency trading then. The ultimate quote unquote evolution of the market, or is a high frequency trading algorithm like a local?
Let me see if I can clear some of this up by making some broad generalization.
A great man known as Shall Not Be Infringed once said that if you want to get a job done, it's best to use broad strokes.
I would agree with that wholeheartedly. And as I do pretty much anything Mike says.
Hell yeah.
But except for him sleeping in his truck lately.
Yeah, what the fuck?
I really want. I'm like I take it personally. Like I really want to I want to call his boss and say what the fuck. You know what I mean?
Maybe he wants to sleep in the truck.
I know there's something about it that's wrong, and he won't open up to me.
Oh.
Anyway, anyway,
yeah.
HFT. All right, look. So originally you had this process by which you had one exchange, the NYSE,
okay.
And you had a specialist on the floor for each. Well, not for each stock, but some represented multiple stocks. Same idea as the pit local, except he's not a speculator. He works for the exchange. He has to make the spread, and he has to match buyers with sellers, even if there aren't.
By law.
Just to meet the
it's worth noting, by law.
He's compulsory, right? And,
yes.
And he must make the trade. So if somebody wants to get out, they get out. He has to get them out. If there's nobody else that he can match them with, is to carry that inventory. This was the original thing, right?
Mm-hmm.
Now we make the contrast between equities, the New York markets, and Chicago, which is the futures markets. Chicago's, like I said before, does not have competition. In other words, you want to trade S&P 500 futures, you trade it at the CME, at their exchange, period, right? You don't look at a level 2 screen like you do in stocks, and you see all these people, all these different exchanges around the world or around the country that are offering a price of what you could buy or sell S&P 500 futures for, right? There's one entity.
Okay.
Okay. With stocks, what's happened is you have now multiple exchanges, which in these cases are not physical exchanges. They're electronic exchanges that are called ECNs, electronic communication networks, or crossing networks, as they're sometimes called. Crossing meaning they're crossing buyers and sellers that are now competing with the NYSE for the volume. So people have the ability to either run their trades through a smart engine, which just finds them the best price, which is something called Reg NMS, which means that the buyer or seller of securities has the right to get the best inside price, and this is published as a Reg MS price at all times of all these people. That's why if you look at your level 2 screen, if you're a stock trader, you'll see that not all the market makers are advertising the best price for a stock, right, at any given time. So you have all this competition now. You have all these electronic exchanges that are competing for this business. in comes what is referred to in a broad sense of HFT. Usually when you hear people talk about HFT, they tend to be referring to that these computers are automatically trading, and they're stealing somehow from the other participants by gaining a speed advantage to sort of scalp ticks or whatever out of the market to pocket it.
Because they can trade for pennies at a time in the span of milliseconds, whereas you and I can't react that fast.
Right. And so usually you hear that. And another thing you hear is that, which is one of my favorites, is HFT represents 90% or 80% or it depends on, every day it's a different number. It's 85, 90, 75. Everybody's got a new number of how much HFT represents. Okay. Two distinctions that we have to make. Number one is only about 2% of the trading firms in the country are quote-unquote HFT trading firms, okay? That's the first thing. The second thing, so now your mind should immediately start wondering, wait a minute, if there's only 2% of the firms, then how come it represents 90% of the trading? Does that make any sense to me, right? Well, yes and no. So the next thing you have to do is differentiate between HFT firms that are speculators, right, that are specifically using technology and algorithms that they've created to be smarter than the auction process in the market, to find inefficiencies for the specific purpose of making a personal profit. And we have to separate those HFT players from HFT players that really aren't HFT players of any kind other than to provide a market-making role. In other words, it's a computer that's doing the same thing for the market that the specialist was doing on the floor. That is a compulsory trader of the volume that comes in that makes a spread and makes the market. But they're called HFT firms because they're trading at the speed of light, and it's a matching engine that is a computer rather than a human being like the specialist standing on the floor.
So the HFT would have some sort of a price tolerance of where it came from, and then based on what the market is doing, it will match itself up to a buyer or a seller?
Right. All it's doing is looking at the total inventory of buyers that it has coming into its, people that want to trade with them. In other words, they're not the traders. They're processing the orders of other traders, right?
So now when we're talking about 80% of the market is HFTs, is it possible then that 80% of the orders then is HFTs, and that's where the confusion is in?
I'm about to tell you. It's really two numbers.
Yeah.
I would say more than 80% of the orders that are processed, that are equity trades that are processed in this country, are being processed by computers through matching engines. So in that sense, if you want to call all that HFT, and it's probably more than whatever the number is that you mean. But the point is it may be more, but it certainly isn't the sinister predatory activity that they're processing orders for all the investors and all the traders that were the same people that were calling the specialists on the floor to trade in 1975. It's the same flow from the same people. Retail investors, institutional investors, retail investors that have accounts with institutions, that have brokers that are working their orders on the floor. It's still the same process that is just being efficiently managed by computers. Okay, but now I'm going to throw you a curveball.
Sure.
So now but there's two numbers here, right? The number is whether. Okay, so now we've speculated on what the percentage of electronic order execution is in the market, right?
Well, now we can't confuse electronic execution with high frequency trading, can we?
Well, I don't know. You see what I'm saying?
Right.
The term is grossly misused because people talk about it as a blanket evil thing, which is there's guys behind the curtain that are programming computers to rob people. then it's like, wait a minute. What are we talking about here? Are we talking about matching engines being high-frequency matching engines? Because it is high-frequency trading, right? I mean,
Yeah.
they're trading. They are trading, but they're not trading for themselves.
No.
They're trading other people's liquidity. So we have to first make that division between the two things of whether it's a firm that's actually trading its own money or investor money, in the form of a hedge fund or whatever vehicle that there is, to actually try to gain an edge from inefficiency and trade against other people. Right now, you have that versus electronic trading in general. So the first question is, what is HFT? And the answer is, it's both, because the industry terms both things using that term, right? And the second curveball that I want to throw you is another stat that you hear, and people get confused because this stuff all gets lumped in together. And I looked on the internet today to see if, when I searched HFT, what I saw. And the first thing that I saw, I think it might even been the Wikipedia page. I don't recall. I think it was, actually. And it said that yada yada, something to the effect that 70 some odd percent of all the trading volume is HFT. But they didn't clarify what I just said. So what are you saying? I mean, you're saying that all the trading volume, because the context of the paragraph was very much leaning towards this predatory thing, right?
Right.
But then they're using this number, and it's like, all right, well, so are you talking, which are you talking about? Because even if they're talking about the predatory part, okay, are you talking about 70% of actual trades, which are prints? Or are you talking about 70% of the orders? Or they'll also say it's increased to 70%, or 70% of this has grown to this, or whatever. And typically what they're commingling there is the difference between one of the tenets of HFT and how it gains the efficiency is through a very controversial process. And I want to make very clear that I'm not weighing in some sort of political opinion as a trader of what I think of this or whatever, because I'm not going to carry that potato, okay?
Right.
But there is a very controversial thing, which is a tenet of these high-frequency engines, which is called quote stuffing, okay? And basically what quote stuffing is that you were talking about the bid-offer spread before.
Yes.
Basically what a quote stuffing engine does is it's constantly actually putting orders into the queue to test to see where the limits of supply are in the market, to see if there really is people or orders that actually do want to execute at these places. Okay, but then what they do is once they've stuck it out there to get the piece of information, they pull it. Okay. And that's the controversial part of that, is that if somebody's talking about this massive increase in volume in the market, there's a massive increase in the number of orders that are hitting in the market, but there isn't a massive increase in the number of prints in the market.
But now quote stuffing is certainly nothing new. I mean, even going back to the pits, if a person was big enough.
That's right. Sell 507.
Yeah.
Sell 507.
It's going to push.
Nobody says anything?
Yeah.
Not selling 507 anymore. See?
Yeah.
It's now. Right? Sell 507 now. Does anybody want to buy 507? Make your eye contact.
That
Nobody
cleared.
does. Whatever. And then,
that price point is cleared.
After you're done with that, if somebody says, sell 506, sold. My sell 507 is no longer viable anymore because the offer is 6 now, not 7.
Yeah.
Right? You brought up the most important point. This process has been executed by humans since time immemorial. This process of quote stuffing. Anybody want to buy 500 at 7? No? Pull it. How about anybody want to buy 500 at 6?
But now there's of course then, going back to where we started out, there's a risk there. If you've got a local ready to go 500 at 7.
Right. Maybe
Guess what? Yeah.
Yeah. So these high-frequency engines have drastically reduced the bid-offer spread on equities, and it's really been remarkable. So how does that benefit the typical retail investor? You hear retail investors say all the time, "This high-frequency trading is ruining the markets. They're stealing from us, and we can't make money anymore," and all this other stuff. And it's like, wait a minute. You're going to buy a stock and you're going to be in it for 37 years, and you're saying they're ruining the market for you? I mean, what are you talking about? I mean, you know, is this process by which they are trying to maximize the efficiency down at the tick level changing what happens at the tick level? Sure, absolutely. There's a price for everything, right? Yin and yang. You can't get a benefit from something without having the antithesis, right, of that for somebody. It's everything in life is like that, right? So, but the benefit, of course, is that through this process of constantly finding where the efficiencies are in the market and where the supply is in the market, has taken typical bid-offer spreads in equities that the stocks that trade on the exchange from the old traders that are listening to this will remember. I mean, it was totally commonplace to see, 5, 6, 7, 10, 15 cents, maybe even 25-cent bid-offer spreads in smaller cap stocks. These huge differences between the bid and the offer at any given time, and virtually every stock now is incredibly liquid, and it's bid offer to the tick and a gazillion up at all times, right?
Yeah.
So by a gazillion up, that's trader speak, but it means that the bid-offer spread is one tick, and you can get as many as you want on either the buy side or the sell side anytime you want, because that liquidity is in the market. So it can't help but be a benefit to the retail investor from a cost basis, because if you buy a stock with a market order, even if you're only going to hold it for a week, you're going to hold it 2 weeks, you're going to hold it 2 months, you're going to hold it 2 years, 20 years, however long you're going to hold it, at some point, and the longer point that you hold that extra money, that extra 6, 7, 10 cents that you have to pay, in other words, the bid's 6, but the offer's 14, you're paying 14 to buy that stock.
Right.
And not paying 6. So it costs you, that 8 cents more to buy that stock. Now you take that 8 cents per share and compound it by 20 years. How much did it cost you to buy that stock at 14 instead of buy it at 6?
Oh man, that shit adds up. That shit adds up.
Absolutely huge. So the notion that a retail investor with a straight face, other than any other reason other than ignorance, could say something like, because of HFT, my opportunities as an investor are being hammered and ruined. It's ridiculous.
Well, it's got to be a lack of faith, because everything that you and I are talking about is what a market does. A market recognizes inefficiencies in price and corrects them one way or the other. And it's also, if we're to believe what Adam Smith and John Locke wrote about, if anybody dares to claim they're a fucking libertarian, this is what capitalism does,
Right. And another thing that people should know, too, is that of that very small percentage of firms that are, we'll call them predatory HFT traders, right? These are people who are writing algorithms, speculative algorithms, that are trying to understand the volume in the market at a nanosecond level and use proximity to the exchange, right? Speed of light, paying a huge amount of money to be as close as possible to get the absolute fastest feed so that they can see the change in the market faster than anybody else can. Those players are competing with each other, because if you aren't operating on that level, it means absolutely nothing to you. You can't even see it with your eyes. So again, what are those little changes happening? Are those guys slugging it out all the time? Sure, but it is absolutely like out of the wheelhouse of anybody who's trading, even day traders that are trading for position for the day.
Well, I mean, much like the pit, that time preference is only zero sum for those same people within that time time
That's
value
absolutely
category.
Right. Absolutely right. Zero sum only applies to other participants. I mean, if you're in a pit and the only people in your pit are arbitrageurs and other speculators that are tick scalpers, it's a zero sum game.
Yeah.
Because everybody in that pit is trying to capitalize on a minute price change difference in the same periodicity, which means that somebody's going to go home with the money and somebody is not.
But now if you, Robbie, are working on an hourly and I'm trading seasonally, we're not even in the same ballpark.
That's right.
You're providing liquidity for me to enter, and you may be providing liquidity for me to exit at my advantage later on.
That's right. I can trade against you that day and I can lose, and 3 months later you could lose too.
Right.
Or I could trade against you that day and I could win, and then 3 months later you could win too.
Yeah.
Or one of us could win and one of us could lose. Not a zero sum game.
Well, and you and I have talked about this. What we don't like about it is neither you nor I approve of any sort of a license to be a loser. To think that it's okay to not win because of some forces without. I can't make it in the market because of HFT, or whatever.
Right. It's
not a business that's cut out for everyone, and I'm not claiming that it's one that I'm cut out for.
Well, like I told you earlier, I've been a one-lot trader in these markets, and not so long ago. I've been a 500-lot trader in these markets, and I'm not talking about long-term programs or the business stuff. I'm talking about my own personal scalping in the market, and I don't see any difference. And I don't have any advantages now that I didn't have before, or disadvantages. Everything is exactly the same. I'm not seeing any differences in the markets in terms of my ability to see what's going on in the market and capitalize on it or not capitalize on it. I think anybody who says that is just making excuses, because I'm not co-located with Exchange. I still have mouse latency and Purian latency. My personal accounts.
Well, that's the thing.
You got to admit your own failures.
Is a trader going to have weaknesses? Yes, of course. There's weaknesses in no matter what anybody tries. But are there strengths to be had? Yes, absolutely. A day trader who is able to have a different time preference than, say, an HFT that needs to maintain billions of dollars of equipment and justify billions of dollars of equipment, because he can sit on something for 3 months. That's an advantage that other entities just wouldn't have. So
let's back up a second.
Sure.
That's also an advantage that he paid for.
Yeah.
Right. Here's the bottom line.
Oh, okay. I see what you're saying.
See what I'm saying? Since age old in any industry, this has got nothing to do with trading. To make a statement like it isn't fair because somebody else has $1 billion to invest in a fiber pipeline in order to gain a speed advantage so that they can profit from a market, and I don't have that advantage, so I'm not allowed to compete in that HFT space, the predatory HFT space, if I wanted to. I hear that a lot of times too. It's like, what do you mean you don't have the ability? If you want to join HFT and be one of those traders and write an algo and be smart enough to do it, and to compete against those guys in the HFT space, nobody's stopping you. But don't bitch and moan and say, well, I don't have the money to invest to create that, so therefore I'm going to cry foul and say what he's doing isn't fair.
Well, the HFT guys.
What if you race cars?
Yeah.
You're sitting on the line with your Yugo. Are you going to say it's not fair because I got a Ferrari? Where do you draw the line? Where's it? People have been arbitraging markets before we had phone lines. You know what I mean? The Rockefellers were selling yens against the dollar and whatever, using advantages that they paid for. These things are as old as the hills. This has got nothing to do with technology or computers or.
But it comes down to perspective. If you see that $1 billion, let's say you wanted to do $1 billion HFT upstart, you're $1 billion in the red. That's
you got to recoup it, right?
So my advantage when we're talking about something that I've paid for as, say, a quote unquote day trader, is I haven't put out that $1 billion that I'm in the red for.
Right.
You know?
And this is, before I forget, I should bring this up too. I touched on it last time, but that world of predatory HFT is shrinking, not increasing. And I touched on it last time because the arms race, as we call it, of competing for speed advantage that went from milliseconds to microseconds to nanoseconds has sort of reached its end. I mean, you can't get any faster than the speed of light. So what's happened is some of the late entrants in this game have invested hundreds of millions of dollars in what they think was going to put them ahead at this arms race. And then they found that once they got there, that they really didn't have that much more of a speed advantage, or weren't able to turn it into something marketable. So they're out this money. They're not going to be able to recoup, and that's why it's kind of funny when you hear this notion that predatory, or whatever you want to call it. I mean, I'm giving it that term because that's how I hear people speak about it. That sort of HFT trading, speculating purely based on a speed advantage, is those guys are in trouble right now. Of course, the technology is moving to microwave, which is way faster.
But that microwave will end up doing the same thing.
It'll be another arms race, and the late entrants to that will be hung, just like the late entrants to the fiber arms race have been. And then who knows where we go from there? Maybe by then we'll be like Avatar.
But again, that's what the market does. Its job is to give us the true value of a security, a product, whatever. It's why a market exists. A place where buyers and sellers mingle and actually come up with the true value of the product that they're passing over. It's even though in this digital age, which is something that you would think we would be able to more easily accept, it really hasn't changed. If anything, I wouldn't want to say that it's gotten better. It is what it is, right?
Right. Well, plus now too, I mean, even when it comes to simple speed advantages, you're still going to, I'm talking futures now, equities isn't my bag, but you're still going to pay. I mean, if you want to be directly co-located, you're going to pay $8,000 to $12,000 a month for that, to be, about as fast as you can be as an individual futures trader, which is, if you really think about it, depending on what your size is, it's not a tremendous amount of money. But even lower than that, I mean, with a dedicated server, within a reasonable proximity to the exchange, which is what I have for redundancy reasons in Chicago, is about 2 miles from the exchange, and I pay a little over $200 a month for that. I don't have to worry about hurricanes, power outages, losing orders, getting gapped over, big horror stories happening. And I'm talking my personal stuff. I'm not even talking.
Well, yeah, I mean, I get what you're saying, because anybody who has been mid trade as a at-home trader that's had a power loss or some sort of an internet connection break will very much be able to sympathize with that pursuit.
Right, but I bring that up because it's like it's $200. I mean, is that cheap enough?
Right. Well, even $1,200, if a person is serious and they're serious about trading, if $1,200 is the best connection that you can get, then
that's 12,000.
Oh, 12,000?
Yeah. But anyway, again, if you're a discretionary trader, I mean, I'm talking assuming that you're not running any kind of an automated program that you've written. You're a discretionary trader. Latency for a typical dedicated server with proximity to exchange is about 1 millisecond, 1 to 2 milliseconds, depending on where you are. And it's like, it's faster than you can think.
Yeah. Well, and if
you're still going to have your latency wherever you are, subsequent to your internet connection peering in or whatever. And of course, you have the ability to use your phone or your pad or wherever you are to peer in. But the point being, this technology and these technologies advantages are available to everybody. But like I said earlier, it isn't going to help you. I mean, if you're a guy who's complaining that you can't make money day trading the S&P futures or 10-year notes or whatever because of algorithmic trading taking all the opportunities out of the market, then I guarantee you that even if you were co-located, it wouldn't help you. Because
that's not where that advantage lay.
Absolutely, it's not where it lays because, I mean, even I know plenty of traders that don't have any kind of dedicated server in proximity exchange that are using the shittiest internet connections and, buttfuck wherever, and are, going toe-to-toe and taking money out of the markets every day, trading periodicities ranging from seconds to, an hour or less in the markets and doing very well. And, they don't have any special advantages or, they're not manipulating anything or whatever. They're just good traders.
But now, at 55 minutes, we're coming up on 56 minutes. I figured I'd offer our audience, if they've made it this far into it, maybe a spoonful of secret sauce in successful trading. Not that I know anything about it, but if a person has this license to lose because of HFTs or whatever, that's not what's going to be what makes them a successful trader. How I see it, and Robbie, please feel free to correct me if I'm wrong, what stands to make them a more successful trader would be if they take an honest look at how they're trading, an honest look at their work ethic, and really ask themselves, what am I doing that's keeping me from being a successful trader?
That's right.
Yeah. It's something they cannot get around and still be able to make it. And this transcends just trading. This would be in any business.
Let me tell you something. It's always been one of the hardest ways to make a living, and that's why it has the rewards that it does. If it were easy, everybody'd want to do it because the opportunities are huge financially, at least. There's other opportunities too in terms of if you love it and it's something that you like to do, of course, that are less tangible. But I mean, if you're talking about income or whatever, it's hard. It's tough to do. I mean, it's not. You're going to have to do a little bit more than whatever the standard stuff is, probably that you can learn on the internet from.
Well, and like you and I have
book or whatever. I mean,
like you and I have talked about, it's because of the paydays. It attracts some extreme talent. We're talking Ivy League MBAs, Ivy League or MIT PhDs. It's extreme talent in this market. Fuck the computers. You're going against some smart ass motherfuckers
at all levels, and by smart, it doesn't necessarily mean education. I mean,
top to bottom.
The greatest traders, the guys that I look up to, because I'm not part of that. I mean, even in our algo business, as you well know, we've talked about it before. I'm a non-predictive guy that's really into the macro behavior of markets. So I'm not from that math school at all, and I'm not from that grind a bunch of numbers until you find something that looks good school of thought. But like you said, that's part of it too. Some of these guys that are doing things in that space, in the math-driven algorithmic space, are absolutely brilliant. And on the other end of the spectrum, the kind of school that I'm from, as a discretionary trader, are the real kind of street fighting, Dems and Does, the Bears, Chicago types of guys that really have high school educations at best and are, they just understand the auction process and a market, and they're good at navigating it and seeing it for what it is. And it's really trading by feel, and not everybody has that. But unlike the computer end of the thing and the math end of the thing, and I take that back. I was going to say maybe it's easier to be an entrant, on that side of the fence than former. But I'm not sure that that's true. I think either one of them are testaments that you got to be at the top of the heap.
Agreed.
I mean, if you want to take money out of the markets, whether you're one of those Chicago guys, the classic, pit local that just made, came from, a gray collar neighborhood, and just went in the pits and made $300,000 a month for 20 years. These stories, and there's hundreds of stories like that. Whether it's that or whether it's the school where you not only have to be a math guy, but you have to be the best math guy. You have to be the best programmer. You have to compete with the best guys to even have a job in the business because the bar is so high. That's where it's at, and unfortunately, the vast majority of retail traders that read a couple books, get a little trading education on the internet, and try to get on there and try to fade Bollinger Bands or trade moving average crosses and run some kind of fixed stop and target scheme and think they're being disciplined and then keep getting stopped out and then go, well, it's a fucking HFT, guys. You don't stand a chance.
But
you don't.
My heart goes out to the people that are getting chopped up, but the guys that you were talking about, the MIT guys, the Street Fighter guys, they got chopped up too. The difference is they didn't quit. They didn't make excuses. They picked their head up and they got it done.
Right. But look, if you go to medical school and you slough off, you don't stand a chance at being a great surgeon.
Yeah.
You know what I mean? If you look at anything in life where the bar is very high, that has fantastic rewards, you can't be marginal at it. I don't care what it is. That's just the way it is. I mean, there's plenty of things to do in life for people who aren't going to try to pursue one of those things that requires that level of because the competition is so great. I mean,
Well, see, that's maybe the other part of the Globex is when you decide that as a day stay-at-home trader that you're going to enter this market, know that Globex is linking you with one of these talented people.
Oh, yeah, absolutely. We're all in there. I mean, look, I think another thing when it comes to day traders in particular, in the tech bubble, it's really the most recent iteration of it. Look, I mean, you could be if you could fog a mirror, okay, you could make a ton of money trading equities throughout the 90s. I mean, all you had to do is you just get along everything and everything worked out. Well, the problem is a lot of those guys that kind of went to the original school of day trading while all that was happening in the equity markets, they made money, right? And they started to think that it was because the moving average crosses that they were using must have worked, right? And that's why they made money. When the truth is, they just made money because the market went up.
Right.
It wasn't because of whatever little scheme that they thought they figured out was actually profitable in the long run. And it's that the danger of kind of confirmation bias when you incorrectly believe that something that you're doing is the reason that you're successful, when in fact it has nothing to do with it. And I think that created a lot of this, where people that were very successful, equities day traders and futures day traders too, from that era, all of a sudden, that kind of carried them through, and maybe they survived through of the crash in December 2000, and then maybe they came back and they did okay throughout the 2000s, and then 2008 came, and ever since then, with the things in the world and whatever, the markets haven't behaved the way that they have.
Well, and these guys, thanks to the internet and thanks to information, they've had a mouthpiece, right?
Yes, and I think that if you're, it goes back to what you said. You have to admit, your own failures, and if the way that a real trader thinks of it is that if you had a way of trading that was very successful and the markets were trending really well, and then all of a sudden you start losing money, you figure out how to adapt the way you trade to the way the markets are now, because the current whatever is the truth, right?
Well, yeah, there's that faith in the present tense.
Right, and so it's kind of the old adage, it's like when the going get tough, the tough get going kind of a thing. And that's the difference is, you can be the type of person where the markets used to trend and you're a trend trader, and now the markets are not trending the way they used to. So you say, well, see, it's those HFT and you can't do it. Well, all you're doing is basically confirming your station in life when you say something. I mean, I sound like such a dick, but it's the truth. I mean, or you're one of the people that goes, This market isn't trending. I'm losing money, and it's unacceptable. I'm losing money. I am going to figure out what I have to do to make money.
Yes.
And that's the difference between the guys in Chicago that were the princes of the pits and the greatest traders that have the biggest funds that are making the most money these days. You know, adaptation. And because the one thing that's true about markets forever, and this, certainly way beyond the time that I've been interested in them, is that they're never doing the same thing all the time. They're always changing, and just when you think you got it figured out, something else is happening. And it has to be that way. That's the nature of the auction process. Nobody or no one side can have too much of an edge at any given time. Why? Because trade wouldn't be facilitated. If it's obvious to everybody that the only way that you can be is long in every periodicity, guess what? There's no sellers.
Well, and I think too,
you can't be long anymore.
Well, and I think
to get your trades on.
As a participant, we need to actually want to have additional participants, because I want to be in a market where it is the true price, you know, and to have and establish the true value for any product, whether it be a security or even outside of the market, you know, something should be worth what it's worth, and it's going to find a way to be worth what it's worth, you know, not to sound like Yogi Berra. But,
and that goes for, you know, a Pepsi in a store, a bag of chips, T-shirt at Walmart, whatever. Right?
Yeah.
Everything's got a price, and there's going to be competition for the price.
Well, and two, if you don't like the price, don't buy it. Don't just sit there and whine about it. Just don't buy it.
That's right. Yep. Have a reason. Great trader once said, you know, have a reason to do everything that you do. You know what I mean? Don't do anything, you know, half-heartedly as a trader. You know what I mean?
Yeah.
If you want to sell sevens, sell sevens. Because you really love to sell. You just like, you couldn't be talked out of it. You're selling sevens.
You know, really, really quick, and something to button up so we can keep this at about an hour right here, because we're at an hour and 7. That reminded me of what was it? Market Warriors or something, that one show. What the trainers, and this is Forex, something we didn't even talk about in this little installment. What the trainers were hoping to hear the people on the desk say, they wanted to hear those people say that even though they lost money, it was a good trade because they had a reason for what they did. You know, that was what they were looking for.
Yep.
You know, they wanted to hear their students say, well, you know, here is what I had established. Here was my scheme, and it was a good scheme, and there you go.
Well, look, and that's nothing could be truer for me. I mean, you just touched on one of my personal mantras. I mean, whether it's a trade that our longer term algos are taking, or whether it's a short term scalp trade that I'm doing personally, my goal, and is something that I'm just absolutely adamant about, is everybody is losing trades, and frequently. It's just part of being in the market. But my goal is to be able to look at every single trade that I lose and be 100% confident that I absolutely wouldn't have done anything different. And I don't wish that I could do it over, because if the same thing happens 1,000 times again starting tomorrow, I'm going to do it that way every single time, because I believe in it. And if I go broke, I go broke, because that's how much I believe in it. And I'm not saying that you don't have to adapt, obviously.
Oh, no, certainly not. If you have a string of losses, obviously your scheme needs some adjustment, right?
That's correct. But at any given time, you have to feel that way about what you're doing, and feel just as good about the trades you lose as the ones that you win. You really shouldn't feel anything about any of them. You should be indifferent about it, because it's whether it's a rule-based thing that you're doing, or whether it's something with discretion, you have a methodology for understanding whatever you're understanding, and it's either proved itself through testing and live trading if it's on the algo side of things, or it's proved itself through through discretionary trading in a variety of market conditions, if it's on that side of things. And you can't, if you talk to anybody who's successful as a trader from either camp, whether they're leaning towards the empirical, mathematical evidence end of things or just gut feel, they have to live on those wits and believe in what they've uncovered through their work, and trust that that's going to carry them forward. Mostly, you really just need to manage your risk, because if you manage your risk correctly, you really don't have to trade that well, and you can still get away with it. And then when you do trade really well, it's like a bonus, because not everybody can trade really well all the time, and not every program can trade every well.
Absolutely, absolutely. All right, man. I very much appreciate your time in this, and personally, on a personal note, I really enjoy these talks.
Yeah, it's been fun, definitely.
Yeah. So, all right, we'll button it up. Any comment section, of course, is open. Blah blah blah, and we'll see y'all later.